Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk to you about an investment strategy that I call livevesting. And it's a tilt on the rent vesting strategy that you might be familiar with. So rent vesting is all about renting in the location and type of property that you want to live in from a pure lifestyle perspective, thereby freeing up all your equity and cash flow so that you can make pure investments. So invest in properties wherever you want to invest them that make the best, have the best investment fundamentals, and then just go and rent wherever you want to, live. And rent vesting, I guess, solves the problem that, if we go and buy where we want to live, it might be so expensive that it exhausts all our capacity to do anything else. However, in my experience with dealing with clients, rent vesting has some challenges, and it's not for everyone. And there's probably three common challenges. The first one is an emotional one. Some people just don't like rent vesting, renting their home, I should say. Emotionally, they want to feel like they own the home that they live in for a security perspective. And, some people just think rent money's dead money. So emotionally, they just can't align with that strategy. Secondly, if you have children and you're rent vesting, that can be a bit of a challenge as well, because if they're going to a school in the local area, then the landlord changes his mind, decides to sell the property or occupy the property. You've now then got to find yourself a new home within a relatively short period of time that is still conveniently located pretty close to that school. And then it's going to depend on the volume of stock in the market and your requirements of whether how easy or hard that's going to be. And thirdly, what happens if you change your mind? So it's great to develop a strategy and implement it today, a rent vesting strategy, and exhaust all your borrowing capacity by investing in properties. But what happens if you wake up one day and think, this is just not working for me, I want to go off and buy a home? And quite often I find clients might be of a certain frame of mind, a certain stage of life that renting is fine, and then they get to a certain stage of life where that's no longer fine, and that's not uncommon. So, it's about understanding that your desires and preferences and comfort levels will be different at certain ages throughout your life. So rent vesting on paper probably works better than in real life. Obviously, the challenge that rent vesting tries to address is the fact that you're spreading yourself too thin. That either if you go and buy the home that you really want, doesn't leave you any capacity to invest, or if you try and spread your capacity evenly over buying a home and funding that, and also funding investment properties, the risk is that you end up with a portfolio of very average properties, just purely because you've tried to accommodate your goals, but you've had to compromise on the price, locality and quality of said assets. So let's talk about livevesting then. And this is a strategy that I've worked on with for a few clients, and that's becoming more common. And this strategy essentially involves using all your capacity to invest in the highest quality property possible. So that's really the home. And the home is bought purely, or as much as possible, on investment fundamentals and for future strong compounding capital growth, but also kind of ticks some lifestyle boxes as well. And the holy grail for some people is buying in a really good public school zone. So if you've got a highly rated public school in a certain zone, typically that also stimulates capital growth in the property market as well. And if you can do that, you can kind of tick two boxes in that you buy a home that's going to have good capital growth prospects, but also you no longer no need to necessarily spend an exorbitant amount of money on private school education. So a livevesting strategy typically requires, or the common theme is that it requires a very large non-deductible home loan. And typically in a traditional investment strategy, the goal would be to get rid of the non-deductible debt as soon as possible, and certainly take no debt into retirement, and you normally rely on cash flow enabled to do that. But the live vesting strategy is premised on the idea that you're going to occupy this property, but only for a finite period of time, and then that you'll sell that property, crystallise the tax-free capital gain, and then part of that gain will be contributed towards your retirement, and part of the gain will be contributed towards buying a replacement home. And that might happen before you retire, or it might happen when the kids eventually move out or finish school or university and so forth. Obviously that depends on your plan. So it's really about servicing the home loan through that period of occupation, rather than necessarily as the traditional sense of buying a home and then repaying it. So let me give you an example of some clients where it demonstrates where live vesting might be better than the traditional way of sort of looking at a financial plan. So let's assume that Rick and Karen are married. They've got 2 kids, family income of $370,000, so a pretty significant family income. And really this strategy really appeals or is most suitable to people, professionals that have a higher than average income, because they typically want to live in those blue chip areas, and they have the capacity to be able to service quite a high level of non-deductible debt. At the moment, Rick and Karen's home is worth $1.5 million, and they've got a $500,000 mortgage, meaning they've got $1 million of equity. So as I said, they've got Rick and Karen have got 2 options. The first option is maybe to upgrade their home to, say, $2 million, so therefore buying a little bit more accommodation, probably same sort of land value. And also they've got the capacity to make an investment grade, entry-level investment grade acquisition for about $600,000. So $2 million home, $600,000 investment property will result in about $1.8 million of debt exposure. Option 2, however, is swing for the fences and buy the highest quality home. So what you're trying to do is take your $1 million of equity and put it into a property that has the highest probability of producing the strongest capital growth. And so therefore that would involve them buying a $3 million family home and no investments. And then the net debt exposure would be $2.2 million, so slightly more than the first option. Now, if we assume in option 1, which is buy the $2 million home and the investment property, if we assume they've had to compromise a bit, they've bought more accommodation value, and, they've got an entry-level property, let's say because they've compromised on the asset quality, let's say the capital growth rate is 6%, whereas for the pure high-grade home, the capital growth rate is, say, 9%. Well, in 20 years, under option 1, they'll have about $6 million of equity, and under option 2, they'll have about $13 to $14 million of equity. So twice the amount of equity after tax in those options, and that's where live vesting really comes into its own, where you're going to get that compounding capital growth. Now, there's this strategy is premised on 2 really important assumptions. The first assumption is that Rick and Karen don't have the capacity to be able to do both. That is, buy a home without making compromises and buy the highest quality investment property without making compromises. And the second premise is that they get the asset selection perfect, particularly in option 2 where they're going for the family home. That is, they buy something that has significant capital growth prospects. And remember, I can't emphasize this enough, the live vesting strategy is the fundamental assumption under that to make it work is that we're buying a fantastic family home in a blue chip location, quiet street, strong land value component, very strong historic growth. That's the sort of picture. Okay, so there's 4 risks that we need to consider with the live vesting strategy. It's not for everyone, and we need to think about the risks. The first one is concentration risk. This strategy is concentrated into one asset. And, as the saying goes, don't put all your eggs in one basket. This is an eggs in one basket strategy. Now, that in itself isn't necessarily a major concern as long as it's a really great quality basket. And that's, again, one of the underlying assumptions. But there is an element of risk there. Two, there's a borrowing risk, the risk of being able to service a large mortgage and continue to service a large mortgage without creating undue emotional or financial stress. That just goes back to planning, making sure you've got buffers, you've got the right insurances in place, doing all the prudent sort of stuff, but certainly not over borrowing. Third risk is the unwillingness to downsize at a particular period of time. If we've said, okay, we want to retire at 60, so we're going to downsize at 59, you get to 59, you don't want to do it. You've got to think about or consider that risk. And the fourth risk with the live vesting strategy is poor implementation. So you get the wrong budget, you strike the wrong budget, you don't have the right loan structure, and most importantly, you mess up the asset selection, so you don't end up buying something that has outstanding capital growth prospects. So all these risks can be accommodated typically with good quality independent advice and advice from a very reputable buyer's agent. The thing is, I think with a certain sector of the market, and that is typically higher income earning professionals that want to live in really established blue chip locations, I think the ideal will change and has changed over time. In the 60s, 70s and 80s, the typical approach to life is, go and get married, have kids, buy a home, build a career with the same employer, work hard to repay your home loan and then retire. And really since the 90s and through the 2000s, people wised on to really accessing equity and becoming more proactive with building wealth, and they repaid their home loan as fast as they could, and then they borrowed against the equity to go and buy some investment properties, and that really helped. And I suspect for a certain amount of people, the notion of going and buying a home and repaying the home loan will be less attainable, particularly again in these really good quality blue chip areas. And maybe what they'll need to make friends with is the fact that they'll just be servicing a loan for the period of occupation until much time that they'll sell, divest, and pull out a substantial amount of equity. And remember, in these blue chip suburbs, few people actually have mortgages. Most people, their properties pass through families, and they have very little debt against them. So we're only talking about a small segment of the market. There's been a lot of talk about the intergenerational wealth transfer as the baby boomers pass on and then leave their wealth to their beneficiaries. Something like, it's been mooted in the Fin Review, about $3 trillion of intergenerational wealth will be transferred across over the next couple of decades. And that might help this live vesting strategy, because if people are expecting inheritances, although it's not something that's very popular to sort of talk about, it might be, of course, and the timing of that and quantum of that is obviously has some inherent uncertainty, but there might be some planning that can be done there. So there you go. There's live vesting strategy. Won't be appropriate for everyone. You need to be very careful with it, but it could be a good strategy that A, ticks some lifestyle goals for you, and also B, make sure you can have a comfortable retirement. So that's it for this week. Until next week, bye for now.